Who really controls the stock market? Let's discover the secrets behind the curtain. Have you ever felt like the stock market is a game rigged against you? Like no matter how much research you do, the prices move in ways you can't predict. Here's a truth bomb for you. The stock market is like a vast ocean, and retail traders like us are just tiny boats. The real waves are created by the big players: hedge funds, mutual funds, and institutional investors. But here's the exciting part. Once you understand how they operate, you can ride those waves instead of being swallowed by them. In this guide, we'll dive deep into who really moves the market, the phases of market cycles, and how you can spot opportunities like a seasoned pro. Whether you're brand new to trading or looking to refine your strategy, this post will empower you with insights that could change the way you approach the market forever. Stay tuned because by the end, you'll know how to trade smarter, not harder. The market is a battlefield. On the surface, the stock market might seem like chaos, a frenzy of numbers, graphs, and news reports. But underneath it all, it's a carefully orchestrated battlefield. Every stock price you see is the result of a tug-of-war between buyers and sellers, governed by the laws of supply and demand. But here's the kicker. It's not us, the retail traders, driving these movements. Instead, it's the institutional investors with their massive capital reserves. When they enter or exit a position, they don't do it all at once. They move in stealth. They accumulate shares slowly during downtrends or consolidations and distribute them strategically during bullish phases. And this creates predictable patterns that savvy retail investors can learn to spot. A common scenario, ever been here? Let's paint a picture. You buy a stock at $100, hoping for a quick profit. For days, the price barely moves and you grow frustrated. Eventually, you give up and sell it, only to watch it rocket to $120 the next day. Sound familiar? If you've been in this situation, you've experienced the power of institutional trading firsthand. What happened here? You were likely holding during an accumulation phase, a period where institutions quietly buy shares. Once their positions are secure, the stock enters the markup phase and the price shoots up. The secret sauce: understanding market cycles. The market doesn't move randomly, it moves in predictable cycles. To succeed, you need to identify where you are in the cycle and adjust your strategy accordingly. Let's break down the four main phases. 1. Accumulation phase. This is where the smart money starts buying after a downtrend. Prices are low, sentiment is bearish, and most retail traders are too scared to enter. Key tip: look for sideways price movement with low volatility and subtle increases in volume. 2. Markup phase. This is where the excitement begins. Prices start to rise steadily, momentum builds, and retail traders begin piling in, driven by the fear of missing out. FOMO. By this point, the big players are already sitting on large positions, enjoying the ride. 3. Distribution phase. Now the smart money starts selling. Prices may still rise, but the upward momentum slows as institutions offload their holdings to latecomers. Retail traders often get trapped here, buying at inflated prices. 4. Markdown phase. Finally, the market begins to fall. The institutions are out, and the retail traders who bought during the distribution phase are left holding the bag. Avoid this phase at all costs unless you're shorting the market. When should you buy? Accumulation or markup? Here's a question for you. If you were buying a stock, would you choose the accumulation phase or the markup phase? Most new traders jump in during the markup phase because it feels safer. But the accumulation phase is where the real opportunities lie. Why accumulation is key: imagine a stock consolidating between $500 and $510 for weeks. It's moving sideways, showing no significant price action. This is where the smart money is buying. By entering during this phase, you position yourself to benefit from the breakout when the markup phase begins. How to spot the end of accumulation. One of the most critical skills in trading is identifying when a stock is about to break out. Here are 3 proven methods. 1. Volume analysis. Volume is like the heartbeat of the market. When you see increasing volume on bullish candles near resistance levels, it's a strong signal that a breakout is imminent. 2. Support and resistance levels. Watch key levels closely. A breakout above resistance or a breakdown below support often signals the end of consolidation. 3. Technical indicators. Tools like Bollinger Bands and RSI can provide additional clues. For example, a contraction in Bollinger Bands often precedes a breakout. Real-life example. The Reliance stock. Let's take the example of Reliance stock. Imagine it's been consolidating around 2,400 rupees for weeks. Suddenly, you notice higher volumes and a breakout to 2,500 rupees. This is a textbook example of the end of the accumulation phase. If you had entered during the consolidation, you'd be sitting on significant gains. Managing risk, the art of moving your stop. Loss trading isn't just about making profits, it's about protecting them. A stop-loss order is your safety net, but many traders use it incorrectly. Here's how to do it right. 1. Trail your stop-loss as the price moves in your favor. Adjust your stop-loss to lock in profits. For example, if you bought a stock at $100 with a stop-loss at $95 and it rises to $110, move your stop-loss to $105. 2. Use the 8 or the average true range, ATR, helps you set a stop-loss that accounts for market volatility, reducing the chances of being stopped out prematurely. 3. Don't chase losses. Never move your stop-loss further away to avoid being stopped out. This is a recipe for disaster. Tools of the trade, indicators and patterns. New traders often feel overwhelmed by the sheer number of tools available. Start simple and focus on these essentials. 1. Volume. Look for spikes in volume as a confirmation of breakouts. 2. Moving averages. Use moving averages to identify trends and potential reversal points. 3. Candlestick patterns. Learn to recognize patterns like dojis, hammers, and engulfing candles. They often signal shifts in momentum. Key takeaways for success. To wrap it all up, here are the most important points to remember. Follow the smart money. Watch what institutions are doing. Their movements create the patterns you see on the charts. Understand market cycles. Knowing the phases of the market can help you enter and exit trades strategically. Patience pays off. The best opportunities often lie in the quiet accumulation phase, not during the hype of the markup phase. Protect your capital. Use stop losses wisely and always have a risk management plan. Ready to level up your trading? Now that you understand how the market works, what will you do differently in your next trade? Share your thoughts in the comments. I'd love to hear your strategies and experiences. And if you found this guide valuable, don't forget to like, subscribe, and share it with someone who's just starting their trading journey. Together, let's conquer the market!